Hello, my name is Jingonelli, and today we are going to be joining an income tax class. Before we watch the video, make sure you subscribe to the channel in order to get notifications for other more classes that I'll be posting on the channel.
Now, last time we were looking at capital deductions and then the other specific allowable deductions. Specific allowable deductions. I looked at the journal. I told you need to note around 4 things. One, what are the composition or different components of business income, or those incomes that are included in the chargeable income for business? What are those? Then remember, in computing tax, we look at the imposition of tax says we charge, tax is charged on chargeable income by applying a rate. But if we say chargeable income, what do we mean by chargeable income? So you need to first know how we arrive at chargeable income. It's the very key thing. We saw that in the employment income. You look at gross income of a person less allowable deductions. You now get a chargeable income. And on the chargeable income, we apply a rate. On the rate applied on the chargeable income, now this gives us the tax that should be paid. Guys, I'm saying should be paid. Now that tax that should be paid, you ask yourself, are there any of the tax credits that are allowable? Tax credits is that you've already paid that tax somewhere. When we say tax credits, guys, it means the taxable person you are looking at can be business, can be partnership, can be anyone, has already charged or paid that tax anywhere. I know partnership don't pay tax, don't confuse it, but it must file a return. So in arriving at your chargeable income, we've said your gross income less allowable deduction. You get chargeable income. On that chargeable income, we apply a rate. And then we derive tax that should be paid. However, on the tax that should be paid, if there are other tax credits that are already available, we mean where you've already paid tax elsewhere. And we saw it can be 3 categories. We have the foreign tax credits, we have the provisional tax credits, and then we also have the withholding tax credits. You find that one is covered in section 112 somewhere. Now, when you less all those allowable, I mean the tax credits on your chargeable income, I mean not chargeable income, the tax that should be paid. When you less the tax credits,
pardon, on the 3 categories of the taxes.
It's what I taught in the class 1. The first day, I told you how we derive chargeable income and how we charge tax. On those, we said we apply a rate on chargeable income. We get tax that should be paid. On the tax that should be paid, if you have tax credits anywhere, and what do we mean by tax credits? Where you've already paid tax somewhere else. Not to have double taxation on the same taxpayer, you are allowed to subtract those credits because you've already paid tax. So you remove them from the tax that should be paid. What are they? There are 3. You have the foreign tax credits. If you have any income derived from abroad and you've already paid tax on it. Then 2, we have the withholding tax credits, and then we have the provisional tax. So once you subtract them, you now derive tax payable, what you should pay for that year, or your liability for the people. We saw that in class 1, the first time I covered that. All right. Now, if we know that, I want to always emphasize how we derive chargeable income, because it's the where marks are, and you need, for you to learn how to compute tax, you must know how we derive chargeable income. And we said chargeable income, we look at gross income of a person. And what does gross income include? Someone share with me, what is the gross income of a person other than exempt income? The Act defines it as it's the total of business income, that is section 18, employment income, that is section 19. We have also property income, section 20, but other than exempt income, you'll find it in 21. So it does not include exempt income. So never include exempt. In short, you don't include exempt income in gross income when you are determining the chargeable income. Then still we said in chargeable income, after getting it is gross income less allowable deduction. So we now saw the allowable deduction. So those allowable deductions, we looked at some of them, and I'm going to request we deduct. Those are general and others are specific. So what are those? Yes, General, what do we have? Guys, you repeat. You'll go through them. Then the specific
Local
what?
service tax.
Yes?
Local service tax paid by an individual.
Yes, that is true, but it relates to an individual. What else?
All expenditures and losses incurred by the person during the year, the extent to which the expenditures or losses were incurred in the production of income included in the gross income.
That is very true.
The amount of any loss on disposal of assets incurred by the person on the disposal of a business asset during the year, whether or not the asset was on revenue or a capital account.
Good. And that one has two things, amount of a loss or gain on disposal of assets. Those are business assets. And business assets, I told you, they are split into two. We have the depreciable assets and then non-depreciable. If you dispose depreciable assets, if you've disposed the entire, we are going to look at them in details today, the entire pool, you now derive, if the sale proceeds exceed the written down value of that pool, you have a gain. And that gain, guys, we call it a balance charge. You are taxed on it. And then if the written down value of that asset in a pool, or the entire pool exceeds the sale proceeds, you now have a loss, and that loss we call it a balance allowance. It's allowable. Then for those who are regarding revenue, remember we are saying dispose of business assets during the year, whether or not the asset was of revenue or capital. That is regarding the revenue. For capital nature, here we look at capital deduction. Capital gains. And this relates to non-depreciable assets, which is immovable property mainly of land and building. But the building, we are going to see which component of building do we look at. Mainly here, guys, for capital gain is not, we are interested in land. The building has, it's a little tricky, we are going to look at it. It's tricky, it's mainly capital gains. You should mainly think of land, which is non-depreciable. But we also have other non-depreciable assets like shares. So when you sell them, and if your sale proceeds exceeds the book value or the actual value of that, the cost of the asset, you now have what we call a capital. You have a gain. That gain, we call it a capital gain. Taxed in line with, in Uganda, I told you it is taxed in line with business income at 30%. So you include it as an income and you charge capital gain on it, or you charge tax on it. However, where the cost base exceeds the sale proceeds, what you've sold, that land, what you've sold those shares at, then that leads to what we call a capital allowance. Or sometimes we call it a capital loss, allowable. Right. Then 20% of incomes is payable by a private employer who proves to URA that 5% of their employees on a full-time basis are persons with disabilities. If you can able to have a clear proof, URA, of course, what happens, you don't need to prove URA before. You will recharge it as an allowable deduction. You will first compute your tax. How is it done? Remember, it is 2% of income tax payable. It implies chargeable income, we apply a rate, we derive tax that should be paid. On the tax that should be paid, Then we less with any tax credits, which we said for any tax credit, withholding tax credits, and any provisional credits or with tax. And then after netting all those off, you get tax payable. Now on that tax payable, it's what we are saying, 2% of that tax payable, provided it's by private employers who prove to URA that 5% of their employees are employed on a full-time basis and are people with disability. They will allow it to you. So you get 2% of what tax you should have paid exactly to URA. You go back and again recompute tax payable. It's allowable deduction. So you realize you first have to compute the total tax that should be paid. I've overemphasized that. I hope, guys, you're okay. Then that 20% rental income, guys, I told you that thing is removed, was repealed. So that's why it is red. And I told you to note. For those who are not in class, they will consider it. And then there is this. We are going to look at that details of land when you go to, I think by the end of next week, when we repeat. Property income, we just need around 2 hours. Finish it. It's mainly rent and a few interest and dividends, and we'll see how we charge them those. Specific allowable deductions. We had meals and refreshments.
Excuse me, sir.
Yes, please excuse.
I beg your pardon on how we compute the 2% income tax payable by private employer who prove URA.
I asked you a question. What does from what you see there, it is 2% on what? I want you to first get to know exactly what it is on.
It is 2% of income tax payable by private employer who prove URA.
Yes.
Sorry?
It is 2% on income tax payable by private employers, provided you can prove to URA that 5% of employees who are employed on full-time basis.
On full-time basis, yeah.
So 2% on income tax payable. You first determine your income tax payable without including this as an allowable deduction. Then once you have determined, assuming our income tax payable is 1 million, it's what we are supposed to pay to URA. So we now if we can prove, we now have you come and compute 2% of people regarding that allowable deduction. 2% of your 1 million, which is around 20,000. So 20,000, you go back and subtract it as an allowable deduction. So remember, you had tax payable of what? Of 1 million. So you go back and subtract and get exactly the chargeable income and charge again the tax at 30%. And then you determine what you get. I hope you get me. We saw now, guys, we saw those allowable deductions and which are general. Then we now need to know those that are specific. I've taken time on these things, guys, because when we start next week computation, I'll be just doing the computations and I will do you around 2 numbers and then I go to property. Rental income, when you look at amendments for this year, it is applicable by the 1st July 2022. It has its own of treatment, which I don't want to confuse you for now, because I've told you for now, don't consider it. We have to cover it under property income. However, we apply the rate for individuals 12%. For companies, it is 30%. But it has to be on they are allowed up to 50%. So I don't want to go into all those for now. We are going to go into it. It has its own way of doing it. So just for now, don't include it here. Just know it was repealed. If you check the act leaves it there, but it highlights it also, telling you that it was not there. It is repealed. It is no longer there. So guys, specific, we saw meals and refreshment. We saw bad debts. Bad debts, we say the key thing, they must have been incurred on income that is included in the gross income, and you have done whatever it takes, reasonable steps to ensure you collect back those debts, and you can't get them, you will be allowed, but only on those actual write-off bad debts which are fully written, you are allowed. But remember, we said you need to have necessary documentation to support that bad debt write-off. For example, I told you about like the board write-off, showing the different stages of how you've been following the customer up to pay and he has not. Then you can also, if you went into liquidation, you can show all that. If you went into courts of law, you need to bring, if you had to take the into courts of law, you had to bring the legal documentation, all that. And the URA will allow you. And I told you how much is allowed. All right, guys, we saw all that. Interest, we saw the interest. We saw repairs of minor capital equipment, guys, your review. We saw research.
Okay, bad debts.
Research. We saw scientific research. And then training expenditure. We saw charitable donations. Charitable donation, if you recall, we said that you are allowable deduction and should not exceed 5% of the person's chargeable income. So this is another tricky thing I want to re-echo here, maybe. Because of how they are computed. They are a little tricky. They are funny. Let me highlight it. The amount of the deduction allowed for donations. I told you, you must read and know who are those exempt organizations to which we charge it. The amount of deduction allowed for the year of income shall not exceed 5%. Shall not exceed. It implies the maximum you can go is 5% of the chargeable income calculated before taking into account the deduction. So you look at 5%. Should be 5% multiplied by chargeable income. Chargeable income before considering donations. English is refusing here. Before considering donations, guys. Whereas remember the one of people with disabilities, it is after you have already computed the tax payable, then you get 2% times that figure. Whereas here you first get chargeable income before you actually consider donations. So before you compute tax, you get the chargeable income. Assuming you got 2 million as your chargeable income, then you are supposed to multiply it by 30%. So that chargeable income, you multiply it by 5%. Right. I hope that is okay. Then we saw assessed loss brought forward, and we said you are allowed that. Maybe something regarding interest here. It was also interest. Something was what was on interest. I don't know that people still recall interest. That I explained. You just go back and read, guys. Cost of intangible assets. We saw that. Mining expenditure. Types of capital allowable deductions. Here is where I want to start from. I already covered initial allowance and industrial building deduction. So I already want to cover mainly two things. And I review maybe for a few of these and we call it a day. And next week we start our computations. Right, guys, but you will be good in these things as you read. You have them, it is a law. Guys, you don't do things because you think of what should be done as you. You do what should be done as per the act. And that is what you have in your reader. So read your notes. Do you see qualifying capital expenditure? Where you have there? They are saying not all capital expenditure qualify for capital deduction. Not everything of capital expenditure. If you recall general principles in considering what Nelly was reading, we consider the incomes that or expenditure that are related to revenue expenditure, not capital expenditure. However, there are those specific allowable regarding capital expenditure, which are the ones we are now covering. They are saying qualifying capital expenditure. Not all capital expenditure qualify for capital deduction or allowance. So what are those that qualify? They include one, expenditure if it relates to plant and machinery, provided they are depreciable assets. Land, industrial building. Industrial building can be a commercial building, it can be an approved commercial building, it can be a hotel, it can be mining, etc. Farm works. Farm works, mainly farm works, you'll find that it includes buildings and maybe any other equipment used in farm, like a greenhouse. And we are going to look at farm. How do we deal with farm? But it is also another where you can construct a farmhouse, or to incur expenditure which of capital nature regarding farm works, you are allowable. But how much? You don't just say it is allowable. You look at what the act says. You will find it is rated to initial allowance. It is 20%. You're going to see how it works on that greenhouse. Then acquisition of establishment of a horticultural plant. That also we are going to find it again when we go to farm works. It is rated to farm works. Please note that some of the capital expenses are already allowable expenses and not need to be considered further deduction, e.g. minor capital equipment, cost of tangible and startup costs, which we saw up. Again, if they are already allowable, they don't give them to you again. You get it once. We saw those. Now, what are those types of deduction we need to look at, or allowances? Initial allowance, we covered that. You said initial allowance is 50%, and it relates to an eligible property. So you must establish what is an eligible property. An eligible property, we said, can be plant and machinery, and we said which is used for or held for use, but it is other than the household equipment or household equipment, furniture, blah, 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 or any appliances. We saw that. And it must have been, if you put that asset for the first time in a 50 kilometer radius of Kampala, you are given the initial allowance. We saw that, but it's okay. We can have a review of it after, because it's going to be related to industrial building, and I want you to get the distinction between initial allowance for the building and initial allowance for other eligible property. Wear and tear. Wear and tear, guys, this is depreciation. Wear and tear is depreciation. People say depreciation is not allowable. Depreciation is allowable. But what is allowable is the one which is computed following tax principles, not accounting principles. That one of accounting is not allowable. We add it back. We use the one which is agreed by tax purposes or for income tax act. And this one, we charge it at different classes. They are depreciated in terms of classes. Class 1, 2, 3, 4. However, one class was removed, so there are only now 3 classes. Class 1, 2, and 3. And we have 40%, 30, and then now 20. So we are going to see that in details. So in short, wear and tear, it is depreciation, typical. Assets losing value through wear and tear. Sometimes it can be obsolescence, but mainly it is wear and tear. And you are given that allowable deduction. You need to know how do we compute it. Industrial building deductions. Industrial building deduction is another one. IBD. We saw that if you set up an industrial building, provided it qualifies, it's going to be given an initial allowance. And initial allowance for it is 20%. I think I covered that. Did I? I don't know. I covered the general one. Yes, I covered the general one. I didn't cover this. You'll be given 20%. And then after that, then you're also given IBD of 5% on straight line basis. Farm capital deductions. Those are the ones related to those greenhouse and farm works, and even that depreciation for the horticultural equipment, which we are going to see now. Right. Initial allowance, that one I explained. I will come back slightly. Maybe if I'm to re-echo it, just review it, they're saying initial allowance is the deduction given to a person who places an eligible property into service for the time outside a radius of 50, for the first time, guys, should be for the first time, outside the radius of 50 kilometers from the boundaries of Kampala during the year of income. The deduction is computed as 50% of the cost base of that property. What is eligible property, which they are trying to stress there up? And eligible property they are saying means plant and machinery wholly used in production of income, including the gross income, but excludes one, goods and passenger vehicles, appliances ordinarily used for household purposes. All household appliances are not considered. And I ask you people are giving, the ladies were the one giving the example. Office and household furniture, fixtures and fittings, all those are not given. Now, other plant and machinery used in production of income, guys, are the ones that are given initial allowance, but it must be put into use for the first time to produce income that is included in gross income, however, outside the 50 kilometers radius of Kampala. Initial allowance on the building, guys, that one also I recall I covered it. He said it is allowed the person who puts into use for the first time an industrial building other than approved commercial building. It's a key one. When you check industrial building, it includes guys, industrial building includes commercial building. But
So
they are saying initial allowance is on first weight, and initial allowance is on industrial building if it is put into the first time, and it is 20% of the cost of the building. But this excludes an approved commercial building. Now you have your question. Yes, you can go on.
What do they mean by for the first time?
First time is that if you are constructing a building, say it was taking you maybe 2 years, now it is ready for use as of now. Or if you took you around 8 months, it is now set to be used. The year in which it is available for use, it is ready for use to produce income, including the gross income. It is the first time in that year. They will give you the first year of when you are including it in your wear and tear. And not necessarily in your, for tax purposes, when you are including it in your account, you are going to be given 20%. I hope you get it.
So it's only in the first year. The second year we don't include.
It is only in the first year. In the second year, they give you wear and tear, and the wear and tear for building is called IBA, which is or IBD. IBA is industrial building allowance. IBD is industrial building deduction. It's the same, which is 5% against the cost of the building on a straight line basis. So depreciation for building is 5%. But this 20% only is in year one. In the first year, you are given 20% and also 5%. Then other years, you are only given 5% on as depreciation allowance.
So it means we add that the 5%
Guys, you are going
and
to
percent.
just note this. Try to learn. You are going to get this when we start the computation. So we look at now wear and tear. This is the main reason why today we are in this class. It is not much. I want to cover this and maybe review also add it on farm. Then we can call it a day. A taxpayer is allowed a deduction for depreciation. Guys, I don't have these things in my head. These are, I know how it is done. I can tell you, we charge wear and tear on this class. But this is the law. That's what the law says. The law says the taxpayer is allowed a deduction for depreciation of a depreciable asset other than minor capital equipment. We saw capital equipment are already allowable, so you don't include it again. Minor capital equipment, if they are less than 50 current pounds or 1 million, that is 1 million, you are allowed that. We saw that. So it implies any depreciable asset is given wear and tear other than minor capital. Building is depreciable, but they are given their own and we've seen how it is done. That 5%. Other than the building, other than mine equipment, capital equipment, we charge wear and tear as an allowable deduction, which is normal depreciation, but computed following taxation principles in those three classes, not the accounting depreciation. So when you are computing, when we do the numbers, the first step, when you find depreciation or amortization, you first add them back of accountant. Then you compute the one of the tax, but it's allowable. So they are saying depreciable assets. What do we mean? When you go to accounting, depreciable assets are those assets that are subject to depreciation. Any asset, tangible and current asset that is subject to depreciation. That is I-16. But this is a law. I will not use the one of an accounting. I'm using one of a tax, which I want you to learn. Depreciable assets means any plant or machinery, any implement, utensil, or a similar article, which is wholly, partly used or held ready for use by a person in production of income, including the gross income, and which is likely to lose value because of wear and tear or obsolescence. Keywords here, guys. It must be any plant and machinery. It can be utensil or an article related to utensil. There you are. That is, those are keywords to note. But remember, up there we said you don't consider this. They should not include minor capital equipment. Those are key areas. Should not include minor capital equipment. And they are saying it is wholly or partially held for use, already for use in production of income, including the gross income of the person. So I'm using the person should have, by a person in production of income, including the gross income, should have used it to produce incomes, including the gross income. And that asset is likely to lose value as a result of wear and tear. Those are keywords, guys. Doesn't include minor capital equipment. It must be plant or machinery or any implement. It can be any utensil or any similar article. Partially, wholly for use, used, or held ready for use in producing income that is included in your gross income. So they give you that deduction, which is as a result, cater for that wear and tear of using the asset. That depreciation. All right. They are saying, note one, a person is allowed a deduction in line with section 27. You will find is allowed a deduction of depreciation for the person's depreciable asset during the year of income, as calculated in section 27. A times B. In short, what does that statement? The key words here. Depreciable assets. They must be assets which are depreciable. We saw up, plant and machinery, can be implement, can be utensil, or any other similar equipment which has been put into use or it is held ready for use, but in production of income, including gross income, but should not include a minor or capital equipment. And we are saying we don't charge an individual asset. We don't depreciate that asset you have put into use. You don't depreciate that one single machinery like it is in accounting. In accounting, you charge each asset separately. Here we are saying they are placed into pools of classes of those assets. So we'll be depreciating a pool. You depreciate the entire class, not one asset. However, we are going to see whether do you depreciate in the year of purchase, you depreciate in the year of disposal. When do you start to depreciate? When do you stop to depreciate? Are keywords that we are covering today. And how do we charge the depreciation? They are saying it's going to be charged in line with the formula here. And what is that formula? A times B, where A is the written down value of the entire pool in which that assets belong. You don't take one asset, the whole pool, the whole class, the whole category. And we are saying at the end of the year. This is another key word. Small as they are key. So for you, compute for me. Let's given that, let me give you an example. During a year of income, we can sell off some assets. In that pool, we will not depreciate them. We will consider what is the remaining balance in that pool at the end of the year. They are saying the value or the written down value in that class of asset, if it is class 1, class 2, class 3, but at the end of the year, not at the start, not halfway, because in between there you could be having other assets, and at the end of the year they are no longer there because you sold them. So we look at the written down value at the end of the pool. If during the year you added some assets, like you added some, you constructed some which are related to that pool, you add them to that pool, but they will be depreciated at the end of the year. B is the depreciation rate applicable to the pool. Remember here there are amendments, but whatever you have is exactly okay, except there is one mistake I saw, which I'm going to edit out as we are going further through. So you'll take note to note it when we reach that mistake. Here it is in actual sense. Note 3, depreciable assets are classified into 4 classes. These are supposed to be 3 classes. That is a mistake, guys. They are classified into 3. Before they were 4, but now they are 3. And we charge depreciation on reducing balance, which we call declining balance. So what are those classes? Class 1, computer and data handling. That is class 1, computer and data handling equipment. Any equipment that stores or holds data is put into class 1. However, that equipment, you don't forget, guys, the principles of different taxation we saw somewhere. That equipment must be in position to, it should not be a minor equipment. I hope you still recall. It should not be a minor capital equipment. If you still recall a minor equipment, we said any asset whose value is below 1, depreciable asset whose value is below 1 million or 50 currency points is treated as a minor capital equipment. It is allowable, but it is allowable on a condition that it cannot be, it generates incomes independent of other assets. It functions independent. Examples I gave you that if you have like a small laptop, these small ones, which are around 600, it's okay. You are allowable that. It's a computer, but since it is below 1 million, it becomes a minor capital equipment. It will be allowable, the whole value. But a desktop will not be allowable because the desktop doesn't function independently. It needs a CPU. Even a CPU will not function independently. It needs a desktop. So they will not all be allowed. So they will be included. All right. Class 2, we have, guys, is a MiFi allowable? Is it a data handling equipment?
It is a minor capital equipment.
It is a minor capital equipment. Good. The data handling equipment, but it's a minor and it functions independently, I think. You don't need, it just gives that, mainly it holds that. Class 2, They cleared the risk. Before there was a lot of involved assets. Some assets were here, like automobile. Some of them were here, cars, and others were here. Plant and machinery used in farming.
Excuse me, sir.
Please, you excuse it.
Is brick or bricklaying equipment part of this on the part in the class 2?
What are you doing? What you are dealing in the bricklaying? That is involved. It involves manufacturing. It must be. You must be a company that exactly deals in manufacturing, not the client. It is okay to be in class 2. So class 2, you are saying it is plant, machinery used in farming, manufacturing, anything used in manufacturing. You are talking about brick. There will be their equipment provided they are.
I want to go to.
And they are not minor capital equipment.
Mbuya church. I want to go to church. Oya bamwita Father Raymond yalinga omuzungu ate muganda tebiki.
Nanyonga, please, Father Raymond ojja mulaba luvannyuma outside class. Class 3 have automobile. Those are cars, guys. Vehicles, and this category of vehicles, we have buses. In short, all vehicles, before they were split, all vehicles, all cars are in the class 3 currently. So you check what you are reading, the previous notes. You'll find others as the saloon cars are spread into class 3, others are in class 4. Please, guys, note. Automobile, all cars, buses, minibuses, vehicles, construction, earth-moving equipment, specialized tractors, trailers, trailer-mounted containers, railway cars, locomotives, equipment, vessels, barges. Those are related to water, tugs and similar water transportation, aircraft, specialized public utility plant, equipment, and machinery, office, furniture, fixtures and fittings. You see where fixtures and fittings is. Before it was in class 4. And equipment, any depreciable asset, not included in any other class. Any depreciable asset, which is not included, which is not plant and machinery used in farming, manufacturing, and mining, and it is not computers and data handling. So it implies any machinery, any item, any equipment, provided it is not included in class 1, in class 2, and it is not a minor capital equipment, and it is not an industrial building. Industrial building is done separately, is included in class 3. I hope you are covered.
Pardon. On class 3.
I'm saying any asset which is depreciable, plant and machinery, equipment. It can be utensils. It can be anything related to utensil, like that article, blah, blah, blah. Implement, machinery, plant, etc. Equipment, provided it is not computers, it's not data handling, which is in class 1. It is not plant and machinery used in farming, manufacturing, and mining. And it is not a capital equipment which is of less value, minor capital equipment, because those are allowable, they are exempt. And it is not industrial building, because industrial building has its own separate way of treating it. Guys, all those go under class 3. So the majority of the things you'll be finding will be for class 3. So take note. We now look at the I've already explained much of those here, but it's just we want to break it down.
I have a question.
What is involved in wear and tear? I'm going to go slow here because that is where the law is, guidance regarding the law. So please note them.
Excuse me, sir, I have a question.
Yes, please.
What happens when an asset is depreciated to zero balance and it is still working?
What happens if an asset is depreciated to zero balance and it is still working?
Yes.
For tax purposes, are you listening?
Yes.
An asset, if it is fully depreciated, the assumption is deemed disposal. It's a deemed disposal. You have sold it. They no longer know it for tax purposes. Hope you follow.
Yes.
Then,
yes.
Then should be not included further if you are to compute depreciation. If you use it as you in your own business, it is for your purposes, but should not be included. It is not. They will no longer give you wear and tear on it. It is deemed disposal. You sold it. We are going to see you can sell by even destroying an asset can be a disposal. If you give it as a gift, it can be a disposal. If it is fully depreciated, it can be a disposal. We are going to see that. However, for accounting purposes, you can reclassify that asset and you bring it as if it's a new asset by revising its useful life. Now that's why accounting and the tax go a little funny. I've had those cases, people in practice asking me. We have computers and they have been used for the next 5 years, yet their useful life is 3 years. What do you do? I was guiding them on what to do. All right, let's look at that. I hope you are guided. The written down value of the pool at the end of the year of income is the total. Remember, we said we charge depreciation or wear and tear on the written down value at the end of the year, whatever is there during that year. If you've already sold, it is no longer there. So in short, we charge depreciation in the year of purchase and actual sales when the asset is available to produce income included in the gross income, but not in the year of disposal. Not one, subsection 4, section 4, subsection 4, part A. They are saying the written down value of a pool at the end of the preceding year of income after allowing any deduction for that year, and then the cost base of the asset added to the pool during the year of income reduced but not below zero. What you are asking, it can go up to zero, but it can't continue to be that. You can't depreciate more than its scrap value by the consideration received or dispose of the asset in the pool during the year of income. What we are talking about in the subsection 4, a written down value where we charge, guys, written down value in the simple accounting is your carrying amount. It is your net book value. How do we get it? You look at what you have at the end of the period. The written down value or the net book value at the end of the year is the total of the written book value or the written down value of the previous year in the entire pool, not one asset, not one computer, the whole assets in class 1, class 2, class 3. What is their written down value last year when you were ending, the closing balance of last year? By that being the closing balance of last year, you've already allowed the deduction of wear and tear for that year. So the written down value of last year, or the closing balance, or the opening balance in short for this year, add the cost base you've incurred to construct an asset, acquire an asset. But they are saying, but reduced not below zero by any consideration received below from the disposal of the asset. In short, long story short, what are we saying? Written down value of the asset is your closing balance of last year. Add any cost base of any new asset constructed or purchased during the year. In short, we call it addition. That is going to be the written down value we will use for computation of wear and tear. However, cost base, if you added a new asset, you either bought it, You could have constructed it, or through as a result of business relationship, somebody gave you an asset. Remember, we said it must also be taxed. Anything you have added, its cost, less any initial allowance. But the initial allowance, you don't forget, it is on eligible property, which is put for the first time. You have brought it into use for the first time to produce income, including the gross income. However, for people, that taxable person should have put it for the first time in a 50-kilometer radius of Kampala, and it must be eligible property. We saw what that is. So that's why you need to read as you keep on referencing these things. Don't read once and you keep on referencing. What does this one say? You go back, look for it, then you easily understand. That is written down value. Guys, you said it's the closing balance of last year.
Excuse me, sir.
Add the cost base. We get written down value. Yes, you excuse.
So what do you mean by cost less initial allowance?
What do I mean by cost less initial allowance? We said the day you put in an asset, which is an eligible property, you are given an initial allowance, and it is 50%. Provided it is outside the 50-kilometer radius of Kampala. If you are within the Kampala areas, Wakiso Mukono, they will not give you that. It will be the whole cost, the whole figure. But it's okay. We are going to see this while computing. Guys, let's go slow. But subsection 5, where the amount of consideration received by a person from disposal during the year of income of any asset or assets in a pool exceed written down value of the pool at the end of the year of income, disregarding that amount, the excess is included in business income of the person for the year. What do we mean by that? I'm thinking, let me attach some more figures here. You may not get that. I'm going to say, assuming class 1. And class 1, we have maybe computer, and this is maybe Dell. Its value is around 1.5. Guys, amounts are in thousands. Then you have maybe another computer, and maybe this is HP. Its value is around 2. It's maybe around 1.8, 1. Maybe 4. And maybe you have data handling, Apple. Maybe Apple what? Apple machine. And its value is around maybe around 1. Maybe 2. What is the total of that, guys? You get 5.2, 5.1. I hope so.
4.1.
Yes?
4.1.
It's 4.1.
4.1. Okay. Good, you are right. 4.1. Now 4.1 as your total. Now after that, we are saying, if I go back and read for you, where amount of consideration is the sale proceeds, what you get from sale, received by a person from disposal in the year of income of an asset, all assets in the pool exceed the written down value at the end of the year of income, disregarding that amount included in the, assuming we are going to sell that Apple machine. Now, if we had sold the Apple machine of 1.2, all right, what is our written down value, guys? Now written down value will be, what is it? 2.9? Yes?
2.9.
2.9. Before we disregard that asset we have sold
Yes.
for that year. Then this should be versus the sale proceeds, which we call consideration. Proceeds. For the received by a person during the year of income for the asset in a pool exceed the written down value of the pool at the end of the year of income. Disregarding. Now we compare the sale proceeds versus the written down value of the pool. If there is any over and above, guys, it becomes an income. We will consider the whole pool, not one individual asset, unless if the whole pool is no longer is fully sold. In short, we compare the entire pool, not one individual asset. We are going to say that in doing our computations. Note 6. If the written down value of a pool at the end of the year of income after allowing for a deduction is less than 50 currency points. Guys, that is 1 million. A deduction shall be allowed for the amount that of that written down value. If that example I gave you, after we have sold, assuming we sold other 2 machines plus wear and tear, the value is now 700. What is remaining in our pool in class 1 or class 2? The written down value is now 1 million. That 1 million is allowable. It is in line with minor capital equipment. There is the way taxes they cross. There is the way they are consistent, guys. The written down, remember, they give any value of capital nature or equipment whose value is below 1 million, you are allowable. Now here they are saying the whole pool after you have sold other assets, and what has remained is total, not one class, but the whole pool is below 1 million. You are allowable. You don't continue to depreciate. The whole of it is allowable. Note 7, where all assets in the pool are disposed of before the end of the year of income, a deduction is allowed for the amount of the written down value of the pool at the end of the period. Where the whole of the assets in the pool are disposed of at the end of the year, a deduction is allowed for the amount of the written down value of the pool at the end of the period. You are going to be allowed the whole, if you sell the whole of it, it is allowed. For that period. However, there's going to be now balance allowances that arise. You will compare the whole pool versus the pool at the market value you are getting, or the consideration, versus the carrying value of that pool, or the written down value at the date of sale. You determine whether there is a gain or a loss, which leads to what we call a balance allowance to a balance charge. Note 8, where a person has incurred a non-deductible expenditure in respect of depreciable asset, non-deductible in respect of depreciable asset, it applies as if the expenditure incurred in different years of income were incurred on acquisition of separate assets for the same class. Those are tricky ones. There are other 2. So that, and we find another one where you construct an asset and it gets ready for around, say, a period more than 1 year. You're going to find it ahead. Where they are saying, what is that? I was ready. Note 8, where the person you've incurred a non-deductible expense A non-deductible expense, guys, we will look at the capital expenditure on that depreciable asset. It's what we mean. Remember, they don't allow capital expenditure as an allowable deduction. We saw what is allowable from your specific. Now, where you incur a non-deductible expenditure, implying it is not among the specific, it is not startup costs, it is not a minor capital equipment, it is an expenditure, that asset. In respect of depreciable asset, it applies as if the expenditure incurred in different years where it is incurred for incurred in different years where incurred for the acquisition of separate assets for the same class. This, if you go back, in short, if you are to note somewhere, you can put this in your brackets and you note it. This relates or is the typical the same way as subsequent. If you recall accounting, subsequent capital expenditure. On the same asset. Subsequent capital expenditure on the same asset. You incur, remember, capital expenditure which is of capital nature will not be allowed unless those we saw up in specific. So if it is of a capital nature on that asset, it is treated as if you've added another asset. It's an additional. So please note, you add it in that separate class of that asset where it belongs. Note 9. Where the cost base of the depreciable asset is added. Example here, guys, this is equally addition. So if you find it, please you treat it as an addition. Where the cost base of the depreciable asset is added to a pool in the year of income in which the asset is placed in service. The cost base of depreciable asset is is added to the pool. It's just emphasizing what we saw up. You add it to that pool in which that asset belongs. But in the period where you have actually brought that asset into service, if it's not yet available for service, you will not bring it. Because remember, when you add it, it is supposed to be subjected to wear and tear. Note 10, where depreciable asset is only partly used in the year in production of income, including the gross income, the depreciation deduction allowed shall be proportionately reduced. Now, this is where we said, guys, we charge, where I started from, we charge depreciation in the year of purchase and none in the year of disposal. Why do we say that? That in the year of in the year of disposal, when you dispose a depreciable asset for tax purposes, you are not going, we charge depreciation at the written down value at the end of the year. So it implies written down value at the end of the year, that asset will not be in place. Is that? As we are saying, we charge depreciation at the end of the period on the written down value that is there available at the end of that period. So it implies at the end of the period, you've already sold this asset, it's not there. So that tells us that we don't charge depreciation in the year of disposal. However, we charge depreciation in the year of acquisition. And where do we get it? That subsection 10, where depreciable asset is only partly used in the year of production of income, including the gross income, the depreciation deduction shall be proportionately reduced. So if you put on what we mean, if you put an asset, whether it is partially used, whether it is 2 months, guys, we'll charge it depreciation, but it will be on a pro rata basis for that period in which if it is 3 months, it will be 3 months. You will charge it 3 months. in that year in which you first put it into use. However, don't forget other principles. If it qualifies for wear and tear, all those, I mean, initial allowance, all those must have been done to that newly added asset. Only the newly added one, you give it wear and tear, and also give it initial allowance, provided the initial allowance, if it is within the 50 kilometers radius of Kampala, and it must be readable property. So guys, keep on reading between now and the time we do the classwork on Monday, so that you have ideas regarding those things. What is the format of wear and tear? We look at, remember we said the written down value of the preceding year, which is the one that is the opening for this year we are in. Assuming we are in 2022, what was the closing balance of the preceding year, which is 2021 now, becomes the opening balance for 2022 for each class, class 1, 2, and 3. Then we add additions for the year, less initial allowance if it is there. You must know what is in initial allowance, what it relates to. Otherwise, it will be another issue which will be causing issues on your side. If you don't give it attention, keep on reading as you cross-reference it over time. So you get what we started with at the beginning of the period: add, additions, less disposals. And then you get the depreciable value. And that depreciable value is where you now charge the rate as per those classes. Class 1, 40, class 2, 30, class 3, 20%. And then you get the wear and tear. And your wear and tear, this is the one where we'll be looking for, guys. This one. You will bring it as an allowable deduction in your computation of business income.
Pardon?
Where?
On the schedule, on the format.
We said you start with the written down value you had last year, which is the one that becomes the opening for this year. You add additions, any newly added asset, which must be plant and machinery, must be utensil, must be any implement, must be any article related to utensil, provided it has been used for production of income, including gross income, and it must be depreciable. However, it must not include that. Ensure you take note of those what it should not include. It should not include minor capital equipment whose value is less than 1 million or 50 currency pounds. It should not include industrial building. Why? Industrial building is done separately. So you must know what is industrial building. We do it separately. So you add those additions, you add it to your balance brought down. Written down value at the start is balance brought down. Then you less what you sold for that year in each pool. You get the depreciable value that is now available. So that value that we compute wear and tear. Now that wear and tear which I've highlighted, the depreciation, it's allowable deduction. And you go take it in your, you get the one, you will add all of them. You get for class 1, class 2, class 3. For each, you add the total, it's the total that will take to your business income in the computation. Do you recall chargeable income, gross income, less allowable deduction? You get chargeable income, multiply a rate. But on the allowable deduction, one of them will be wear and tear. So this is it, the total of all that. I don't want to take much of those gains or losses. I already explained that. Gain on disposal, if you sold off all assets, You see this? That is a key word. If you have sold off all assets in a particular class at a higher value than written down value, then the excess becomes a gain, is taxable, which we call a balance charge. And if it is less, we mean the written down value exceeds the consideration or the sale proceeds, then it becomes a loss. That loss is called allowable. It's an allowable deduction, which we call balance allowance. In a situation where the written down value at the end of the year is less than 1 million, then it is allowed as a deduction in that given year of income. We already explained this. Similar and related to that capital minor equipment of less than 1 million. Guys, we don't look at, it is not for one asset, it is the whole pool, the whole class. If it is less than 1 million, the whole of it, the whole figure is allowable, but not more than 0. It can't be depreciated exceeding 0. Where the asset in a particular class have been disposed of before the end, and then you take the written down value at the beginning of the year, compare it with the consideration received. And if more, then it's a loss, and if consideration is more, then it's a gain. It emphasizes what we saw there up, but they are telling us if it's the whole class and has been sold, we consider basically written down value at the start. Compare it with the sale proceeds you have sold it. It's just an emphasis of the first one. Purchase or acquisition of depreciable assets. Those are additions. We said you add them to the cost base after you have less initial allowance. In the year of income in which it was first placed into service. If you check there, it's the same thing. It's just emphasizing what we already saw. Purchase and additions of plant and equipment, machinery, which qualify for wear and tear, are recorded at their cost of acquisition less initial allowance in the year of income in which the asset was placed in service. The amount is added to the written down value, if any, of the relevant class or pool of plant and machinery. This is what I was talking about. If you purchase an asset and it is more than across 2 or more years, asset or more years, an asset may be purchased over a period of 2 years or more years. Take an example of a factory equipment plant acquired over a period of 5 years, where the person incurs an expenditure in respect of depreciable assets or machinery and equipment, and is more than 1 year for income. It exceeds 1 year of income. It is, in short, it spreads into 2 years or more than 2. The Income Tax Act states that the expenditure incurred in different years of income relate to acquisition of the separate asset, but of the same class. It is tricky, but if I'm to explain, it relates much like construction work or development. If you are developing a machine, or you are constructing like a building, it can be a building, it can be any plant and machinery. But if the construction is going to take 2, 3, 4 years, it implies you can't have that cost in 1 year. The cost exceeds 1 year. So what does that say? This act says it is spread. That cost you have incurred, in that 1 year, you will determine what relates to that year. In the next year, you also determine what you incurred in that year. So for the one for this year will be a cost added in this year, and you'll be given initial allowance for that year. If it spreads in the next year, what you incurred to construct that plant next year, equally it will be computed and added as if you have added. You forget what you added at the start, as if you've just constructed a new asset in that year. And if it again exceeds the second year, it goes to the third year. You forget the first and the second year. In the third year, you consider it as if you've just added a new asset. When do we say an asset is disposed? Plant and machinery disposed of or written off from the wear and tear schedule, are written off from wear and tear schedule by the consideration received on disposal, or how much you exactly received. Other than we don't remove it at cost price. The consideration price received for plant equipment disposal should be subtracted from the written down value in the appropriate class of the plant disposal. The disposal of an asset is described by section 51 and include any of the following. When do we say we have sold off an asset? Under what? That is the key one. Section 51 guides that this disposal takes the form of any of the following. When do you say you have sold? 1, sale, exchange, redemption, distribution of an asset by taxpayer. If you distribute your asset to someone else, if you give it someone else, if you sell it and you receive cash, whether you sold it for free or you gave it as a gift, guys, is a deemed sale. That is 1. Transfer of an asset by a taxpayer by way of gift. You also gave it someone else. You give the car, which was for the business, you give it to your girlfriend you've got, or to your wife. Or to your son after he has pleased you after getting a first class. You get a company car and you give it to your son to cruise. It is, you have disposed of. An asset destroyed or lost. If an asset is any burglary and has happened and has destroyed it, or it is lost, or the car has got an accident, it can no longer work, it is deemed to have been disposed of. Conversion of an asset from taxable use to non-taxable. You use it for purposes where it cannot be taxed. It will also be deemed to have been sold. They are saying the taxable, the taxpayer is deemed to have disposed of the asset at the time of the conversion of the amount. They are trying to explain D, equal to the market value of the asset at the time to have immediately reacquired the asset. When you sell an asset, or you got, like, you are exchanging your asset, or you have converted it for a non-taxable purpose, the cost, you remove it at its sale proceeds. In short, you get the written down value you had before, the book value of that asset. You compare it with the market value now. If I'm to acquire that asset in the market, what would it go for? You assume you have sold it and you remove it and determine whether there is a gain or a loss. The gain will be taxed, the loss is allowed. A little tricky, guys. That is tax for you. Those are laws. But you have time to read them and get them. Capital gains, trading receipts, capital allowances, balance allowance. I already explained that. I'm not going to go to that.
Excuse me, sir.
Yes.
Sir, I'm lost.
Where?
On disposal of depreciable assets.
Where? It's a lot. I don't know exactly what you want.
Like from the beginning, plant and machinery
I will
disposal.
not go back to the beginning. It's a lot. I already explained. Just continue from where we've covered. Others, you will get all these guys. You read. I know you can't get them in one day. Equally, me, I've told you I can't recall everything. I know principally what it says, but this is the act, guys. It's a law. I can't put all of these things in my head. So you must read, continue to practice to be better. Even me, I can't deceive you that in one day I will have all this in my head. I can't. I just have to have my act. When I need it, I just know where it is found. I see what the act say, I do it. That's it. If I'm doing it for, say, a client, I don't have to use my head. I must go visit the act. I see what the act say. I do it as per the act, and that's it. So you'll get all these over time. You can't get it in one day. Continue to read. Now, guys, we have an asset which is used for business and private purpose. If it is used for business and private purpose, wear and tear is allowed only for that period it is used for business purpose, full stop. Wear and tear is chargeable, yes. For only that portions, all those days, they can be hours in which it is being used for business purposes. To generate income, including the gross income. So that one, I'm done it there. I'm not go back to read everything. It's a lot. I want to cover this, and if okay, I guide you to write about farm, and we call it a day. restriction on the cost base of the road vehicle. Another key one. Are you allowed to move with the act in an examination? At this level, you are not allowed. At higher levels, you are allowed, but here at MOOCs, you are not allowed. At a university level, you are not allowed, but at a professional level, you are allowed. You can go with your act. However, you may find you don't have a time to open that act because some of you are not used on how to open it. You are not used on how the act works. You can even get lost. You can find you are wasting around 30 minutes looking for something small, taking the 2 marks. The act is very big, guys. It needs people who have been reading it and you know exactly where do I go. So you read what you have. Restriction of a cost base of a roads vehicle. Guys, if you have a roads vehicle, we need to know what is a roads vehicle. When you go check down commercial roads vehicle, means a commercial vehicle means a road vehicle designed to carry loads more than half a ton or more than 13 passengers, or used in transportation or vehicle rental business. That is a commercial vehicle. Restriction of the cost base of a road vehicle. They are saying for the purposes of depreciation, the cost base of a road vehicle other than commercial, a road vehicle cost base other than commercial should not exceed 60 million. In short, what do we mean? We mean saloon cars, if I'm to summarize it for you. I hope this is the spelling of the saloon cars. Those cars like of the MD, they are around 7-seater cars. Even if it is a 4-seater. Spatial, I think it can be a 4-seater, it can be a 7. The Wish is a 7. I think there is even a 3-seater. I don't know which car is that, but it is there. There are those which normally. Anyway, if it exceeds 13 personnel, it becomes a roads vehicle, which is now commercial. It's a car, but commercial. Example is a taxi. A taxi is designed to take 14 people, though the Ugandan people are even put there around 18. 2, we have a commercial roads vehicle like trailer, all other vehicles other than whose ton, provided its ton exceeds half a ton and exceeds 13 people, it becomes a commercial vehicle. There are those cars which are designed to transport, like rent people abasenguka, those canters, and then there are those LFs and the forwards for Musenyu, blah blah blah, broker, those ones. All those are commercial vehicles. But saloon cars are the ones we are looking at mainly. So you are saying where you purchase a saloon car and its value is exceeding 60 million, you have bought 2 cars. Note that. Where you purchase a saloon car, assuming you buy maybe a TX and its value, say a V8 and its value is around 400 million. You have bought 2 cars. Its value is limited for depreciation purposes. Its cost base is limited only 60 million, not exceeding 60 million. Any excess of 60 million is deemed to be another purchase of the car, not depreciable, and not given wear and tear. Rather, it is now treated as a business asset, which is not depreciable. It is funny. That's what the act will say. If you purchase any saloon car and whose value exceeds 60 million, what is depreciable? The depreciable asset in that saloon car is limited only to 60 million. Over and above 60 million is deemed to be another asset, a business asset that is non-depreciable. And now capital gains comes in. Hope you recall, if you have a depreciable asset that is, and you sell it at one time T, which is a non-depreciable. So over and above the 60 million to become a non-depreciable asset. Right? So what are they saying? Where the cost base of the roads vehicle is beyond 60 million, the person is treated to have acquired two assets. The depreciable asset is being the roads vehicle with a cost base of equal to 60 million, and the business asset that is not depreciable asset with the cost of any excess above 60 million. And where you sell it, later you sell that car, assuming after you've used it for 5 years, you sell it, you have again sold two assets. You sold both the depreciable asset you have, which is equal up to 60, whose cost base was 60, but of course you will sell it at net book value at that time. Then you compare, also you would have sold another depreciable asset, I mean a non-depreciable asset, any excess above 60 million. And the gain on disposal of that business asset, which is non-depreciable, is included in the computing. You compute capital gains on it in your business income. Industrial building, I already explained to you, but what you need to note, industrial building works for approved purposes. And what are the industrial building? Must be manufacturing operations, research and development into approved new methods of manufacture, in mining operations, and in approved hotel business, and approved hospital, and approved commercial building. All these above, the 5 up, these ones. Something, if I'm to echo something, we covered that. All those are given initial allowance up to 20% for the first time when they are put into use. But this approved commercial building is not given initial allowance. But all of them, including that approved commercial building, they are given a deduction of 5% on a straight line basis as IBD, industrial building deduction. We saw that. So you go back, read. The last big thing I'm covering is the farm capital equipment, and we call it a day, guys. I want to use around 3-5 minutes. I cover that. I don't want to exceed your time. Who is that one in love? I'm saying, is it Annie Jingo? Okay, let me finish my tax. Farming capital deductions. What do we mean? Guys, farming capital deductions, you'll find they are mainly relating to the two things. But we need to first know what farming means. Pastoral, it means pastoral, agriculture, plantation, horticulture, or other similar operations. Agriculture, plantation, horticulture, pastoral. It can be anything related to animal husbandry, anything related to agriculture, can be poultry, all those. Another keyword. Now the keyword is this that we need to know while reading this section. Farm works means any labor quarters and other movable buildings. Quarters are like where these people stay, those who work on the farm. Who is that guy called income tax? Guys, labor quarters and other movable buildings necessary for proper operations of the farm. Fences, dips, drains, water, electricity supply. We have windbreaks and other works. I've never seen them. Necessary for farming operation, carried on to produce income, including a gross income. but does not include any. Does not include farmhouses and depreciable assets. Guys, they are saying labor quarters for those people who stay in, those who work at the farm. A movable building are treated to be farm tools or farm works. Not expenditure incurred by a person in acquiring a farm work is included in the person's pool of class 4. No, class 3. Guys, you change that in your reader. That is a mistake. Expenditure incurred by a person in acquiring farm works included in a person's pool of class 3 assets in the year of income in which the expenditure is incurred and depreciated accordingly. So you depreciate it using the principles of class 3. So they now tell us, what do we mean by horticulture? Horticulture includes propagation or cultivation of seeds, bulbs, utunguru, spores, similar things, propagation, cultivation of fungi, propagation, cultivation of environment other than soil, weather, natural, artificial. A person carrying on a business of horticulture in Uganda to produce income, including a gross income, who has incurred an expenditure of capital nature on 1, acquiring, establishment of a horticultural plant, and then construction of a greenhouse shall be allowed. This is a key note. A deduction equal to the 20% of the expenditure in the year of income in which the expenditure was first incurred or put into place for the 4 years. In short, farmhouse, greenhouse, horticultural plant, it's like an industrial building, the treatment. It's typical like a building. So this one is also not included, guys. It's going to be taxed as typical the way we do industrial building. However, it is given an initial allowance of 20% for the 4 years if it relates to a greenhouse. Remember, we said of any other expenditure which is capital nature incurred by these people are included in class 3, except acquisition, establishment of a horticultural plant or a construction of a greenhouse. That is treated separately. It is treated the way we do industrial building. So it is given an initial allowance of 20% for the 4 years. You still recall startup costs? For them, they give 4 years. Remember, industrial building, we said it is given 1 year in which it is first put into place. But if it related to farm, they are given 4 years, 20% allowance. Expenditure of capital nature incurred to establish a horticultural plant include expenditure incurred on draining, clearing land, etc. Those are the ones. Capital gains, we saw this. Guys, we have around a minute. I beg to stop here.
Thank you so much for watching. Make sure you subscribe to the channel.